joining me. This is Total Growth Investing, where price growth is not enough. Dividend growth is not enough. We want to identify stocks, funds, and other investments that perform well in both of these measurements, because when we find them and buy them, we can beat the market over the long term. Last time I did a deep dive into my number 3 ranked total growth investing stock, Tencent Holdings. This week I want to look at number 5 on my list, DR Horton. The symbol is DHI. If you're interested in the current number 4, Global Payments, I did that video back in July, before I started the series with background music on my new computer. I'll recreate that video next summer because I want to give it at least a year. There are plenty of other stocks to look at after all. DR Horton bills itself as America's builder. It was built from the ground up by one man, Donald Horton. Now 70 years old, he was born in Marshall, Arkansas, and originally studied to be a pharmacist, but then joined his father's real estate company. He was a natural salesman and was very ambitious. Thinking that the Ozark Mountains were too small of a housing market, he moved to Fort Worth, Texas in 1977 and joined the office of a local homebuilder. 1977 was 32 years after the beginning of the largest boom in population growth that the United States had ever experienced. After World War II, the greatest generation that had survived the Great Depression and won the Second World War had produced a very strong economy during the 1950s and 1960s. They wanted to start families, rebuild a country still recovering from the Depression, and help rebuild Europe and Asia, who were damaged so badly by that war. This economy was fertile soil for many entrepreneurs trying to find their niche. Donald Horton found his in the middle of two different methods that home builders in the 1970s were designing and building homes. There are two main ways that a house can be designed by an architect. You can either go fully customized, which can be very expensive, or you can go fully pre-designed with all of the details worked out in advance. The advantage of the pre-designed homes was cost, because if you only had one set of blueprints to work with, you can reduce costs significantly with economies of scale for both labor and materials. Donald Horton found a third path. The very first home that he built in Fort Worth was a fully blueprinted design. But the buyer asked a question that changed the way Horton approached things from that point forward. Could he add a bay window here? Yes, for an additional $500. Done deal. It was a third way, with the home mostly pre-designed for costing, but establishing set prices for additions and modifications. It made his company very popular. I have found the annual reports for DR Horton going back to 1996, and the story of the growth of the company is well presented. Here are the numbers for revenue and net income from 1994 to 2019. The mortgage crisis that led to the 2007 Great Recession hit the company very hard, but the recovery over the last 10 years has been very strong. It's that recovery that brings them to the top of my total growth investing watch list. Let's explore the expansion of DR Horton over the last 3 decades. The annual reports do provide a series of maps, but that only started being included in 2004. I decided to have fun with it, so here's a visualization of how they have grown, starting in 1977 when they opened in Fort Worth, Texas. The blue dots are DR Horton offices that they opened in new housing markets around the country, and the red dots are mergers and acquisitions made by the company. This was time-consuming, but fun to put together. Note to the board of directors, if you ever watch this video, please indicate going forward what new markets you enter. It took a while comparing lists from each annual report year after year, but maybe that's just me. In 2019, DR Horton was the number 2 home builder in the United States by gross revenue. They have been in a race with Lennar Corporation for the number 1 spot for a few years now. What I found the most useful about this list on Statista is that all 10 of these companies are on the stock market, so we have a way to easily compare them. Total returns. Here's a look at how they've done in 2020 so far. Here's a 5-year comparison. And here's 10 years, and here's 20 years. D.R. Horton is in the top ranks for each time period. Another important measurement for home builders is how many homes they have built and closed on. By that measurement, according to Builder Online, D.R. Horton has been in the #1 spot since at least 2004. D.R. Horton currently sits 72.85. Their price performance over the last 10 years, 488.22, total return of 557.30. That doesn't give you the complete full picture. Let's look at total return over the last 20 years, 1,477.53. So here's that Great Recession that we had due to the housing crisis. And it took them a while to start recovering back in 2011. But like a lot of the other companies and a lot of the other parts of the economy, it started building in 2011, and it didn't stop until COVID hit. And you can see how well they have recovered from COVID. Their current yield is 1.13%, which may sound low, but look at that growth rate again, 25.59. This says dividend growth has been going for 6 years, but let's do a check on that. So 6 years here, yeah, it's right. But look back. They had a massive increase in growth in the dividend from 1997 all the way to 2006. Then that crash hit, and they started recovering in 2011 like we just saw, and they started building their dividend back up to the high point starting in 2013. So this is a company that provides a growing dividend back to shareholders whenever their business does well. And that's certainly what you want to see in a dividend stock. The next thing to look at is current yield, the dividend yield, and how that has gone over the last 10 years or so. So here it is going back to January of 2011, and it's pretty much constant. A good average over the last 4 years of 1.18, but you can see that going back all the way to 2011. Here's the spike due to the COVID crash. Whoever got in right here is pretty lucky. But you can see a constant rate, a constant current yield. But it's a growing dividend, isn't it? So that means yield on cost. So let's look at yield on cost over 5 years, over 10 years, going up to 7.5, over 20 years, going up to 15. Here's that crash again from the Great Recession. And all, yeah, if you'd bought at the IPO, you'd be getting 26.4% right now. Now, past performance does not equal future results. So what do we have coming up for D.R. Horton in the future? I just want to highlight some of the more recent articles from Google News. But let's start with this clip from their earnings call from November 10th.
The Horton team finished the year with a strong fourth quarter, which included an 81% increase in net sales orders to 23,726 homes, and a 60% increase in consolidated pre-tax income to $1.1 billion, and a 27% increase in revenues to $6.4 billion. Our pre-tax profit margin for the quarter improved 340 basis points to 16.5%. And our earnings per diluted share increased 66% to $2.24. For the year, consolidated pre-tax income increased 40% to $3 billion on $20.3 billion of revenues. Our pre-tax profit margin for the year improved 260 basis points to 14.7%. And our earnings per diluted share increased 49% to $6.41. We closed a record 65,388 homes this year, an increase of over 8,400 homes, or 15% from last year.
What is causing an increase like that? Well, we've been dealing with the global pandemic since December, almost a year. There has been an exodus from our inner cities. And while the economy has taken a major hit, the people who were ready to buy homes at the end of 2019 had already put into place the means to make that dream of home ownership a reality. Having the crisis hit like this was just more fuel to that fire. From that Fox Business article, looking ahead, D.R. Horton expects to build between 77,000 and 80,000 units in the current fiscal year, compared with analysts' average estimates of 75,981. Consolidated revenues are forecast between $24 and $25 billion. Let's do a quick back test on Portfolio Visualizer. If we had put $10,000 into DHI in January of 1993, which is when the available data shows up, we would now have a portfolio of $645,272. Compounded annual growth rate over that time period, 16.15%. That's not bad. This is logarithmic scale. That's not bad at all. D.R. Horton is getting the attention of investment analysts, and Google News makes it really easy to follow. They just won a parcel at auction in Arizona. They just acquired Brazelton Homes out of Corpus Christi, and they're building rental units in Dallas. These are just some of the headlines that I'm seeing. There is a lot, and I mean a lot, of data in those annual reports, much more than I would have time to dig into here. Check my Rizzoma notes for the links to all of those annual reports. I want to close by looking at dividendstocks.cash and the valuations. D.R. Horton has stability numbers actually lower than I expected. Dividend stability 0.51, earnings stability 0.4, cash flow stability 0.29, and revenue stability 0.52. So from an income perspective, this is only ranked at number 76. Here's a graph of the stock price going back as far as we have data. There we go. So let's bring in some of the numbers. Earnings per share. Here's the Great Recession. They struggled and then recovered. Started really recovering back in 2011. Let's bring in adjusted earnings per share. Never actually dipped down. That's good. Operating cash flow. So they had some struggles in 2013 and recovered. They're doing okay now. Here's dividends, which is kind of hard to see given the other numbers. So let's take those out. There we go. That's the growth we would like to see. But let's bring the other ones back in, because what we want are fair value numbers. So here's fair value based on earnings per share. Looks like that started a calculation back in 2011. That's fine. So let's do a 10-year. So again, green line based on earnings per share. That line is based on adjusted earnings per share. And this one's based on cash flow. According to this, the estimates are that cash flow is going to drop, but with what they just reported, I'm not sure that's true. This is an aggregate of what the experts think might happen over the next couple of years, given the industry. So if we bought right now at $72.85, let's take the middle number, we would see a gain, $165.13 if we put 1,000 in. They do pay a dividend. I want to show why D.R. Horton is currently ranked at number 6 on my Total Growth Investing ranked watch list. I base my ranking system on 3 main categories: payout ratio, dividend growth, and price growth over 1, 3, 5, and 10 years. The payout ratio is currently 11.98. That's 101 out of however many stocks, 673. What really makes the stock rise to number 6 is their recent performance over the last 1 and 3 years. The DHI ranking system gives a preference to stocks that have shown great performance over the more recent time measurements because I want to catch stocks that are starting to rise quickly. Over the last 3 years, DR Horton has been rising higher than the S&P 500, which you can see in this total growth chart from Seeking Alpha. And their recovery from the COVID crisis has been fantastic. It really all boils down to math on the spreadsheet. Thanks for watching. If you liked this video, please hit the like button and subscribe to the channel. This is a hobby of mine, and this particular video took much longer than I expected because I wanted to put together that expansion map. Please let me know if you have ideas to make them better. I'll start working on the next one over this coming week, probably on Pool Corporation, currently at number 4. And I will continue to read the annual reports for DR Horton, Tencent, and the other companies that I'm watching. I hope your portfolio stays green and growing.